Good morning, good afternoon, or good evening, wherever you are listening.
Hello there.
Today, we're doing a deep dive into some really fresh insights, hot off the press from Marriott International's Q2 2025 earnings call.
That's right. And our mission today really is to cut through all the noise, the financial reports, the executive comments,
Hmm.
and pull out the most important nuggets.
Hmm.
We're going to help you understand Marriott's performance, their strategic moves, and what it all means for the bigger picture in hospitality.
Think of this as your shortcut, your way to get incredibly well informed on one of the world's, well, biggest hotel giants. We'll uncover some surprising facts, key insights.
Make sense of the numbers.
Exactly. Making sense of the numbers and the strategy, all tailored just for you. Okay, let's unpack this.
Let's do it.
So to kick us off, how did Marriott actually do in Q2 2025? I mean, it sounds like the results were strong, but there was macroeconomic uncertainty swirling around. What's the real story?
Indeed. They reported strong second quarter financials, actually ahead of their previous guidance. Global RevPAR, that's revenue per available room, it rose 1.5% worldwide.
Okay, 1.5%.
But what's really fascinating here is the split. International markets saw over 5% growth.
Wow.
While the US and Canada RevPAR was, well, basically flat year over year, it ticked up nearly 1% if you adjust for the Easter holiday shift, but still quite flat.
That's a pretty significant difference, a tale of two recoveries, maybe. Does this signal something bigger about global travel patterns? Maybe a stronger rebound internationally versus maybe some lingering issues for business travel in North America.
That's a great point. It could well be.
So let's dive into those regions. Where was that international growth strongest?
Yeah, so the international RevPAR growth was really led by exceptional performance in both APAC, Asia Pacific, excluding China, and EMEA, which is Europe, Middle East, and Africa. APAC RevPAR jumped an impressive 9%. That was driven by strong ADR, the average daily rate, and just higher demand from international guests. Japan and Australia saw double-digit increases.
Double digits, wow.
And EMEA RevPAR rose 7%. Again, solid increases in both ADR and occupancy, lots of transient demand, both people traveling within their countries and cross-border.
Interesting.
And even with, the conflict impacting the Middle East in June, that region still saw over 10% RevPAR growth. Europe was up a solid 4%. So yeah, some international spots are really benefiting from that pent-up demand.
Okay, those international numbers are impressive. But back to the U.S. and Canada, where RevPAR was flat. What's dragging it down? Were there any bright spots at all?
There were. The growth was strongest at the very high end. Luxury RevPAR was up 4%.
Wow, luxury holding strong.
Exactly. But it definitely weakened as you went down the chain scales, towards the mid-range of
Yeah.
budget options. So, second quarter, U.S. and Canada select service hotels, your typical mid-range, maybe limited service spots, and the extended stay hotels, their RevPAR actually declined about 1.5% year over year.
Declined. Okay, why was that?
Well, it seems primarily due to a pretty notable drop in government demand. Apparently, 2/3 of government revenues are concentrated right there in that select service segment.
That makes sense.
And on top of that, weaker demand from smaller business customers, too.
Okay, that paints a much clearer picture.
Yeah.
So looking at these different customer segments then, what's the takeaway? How are people traveling right now?
Well, if you break down RevPAR by customer segment, leisure transient actually grew the fastest this quarter. It was up 3% globally and 1% in the US and Canada. So individual leisure travel is still quite resilient.
Okay, leisure's good.
Group RevPAR also saw some growth, up 2% globally, 1% in the US and Canada. So large gatherings are recovering somewhat.
Right.
But business transient RevPAR declined 2% globally and also in the US and Canada. Yeah. Partly that Easter timing shift we mentioned, but also just ongoing economic uncertainty. And that government demand piece was particularly weak, down a significant 16% year over year for U.S. and Canada government room nights in Q2.
16%, wow.
Yeah. So it really highlights how sensitive some segments, like government and small business and that mid-market, are to economic shifts and, budget constraints. Leisure's holding up, but business travel, especially in North America's mid-market, still faces challenges.
Interesting. So, okay, that's the Q2 performance snapshot. But Marriott isn't just reacting, right? They're making big strategic moves. I heard their development pipeline hit a record level. And net rooms grew, what, 4.7%?
That's absolutely right. That's the long-term vision story. They are aggressively signing deals. Q2 deal signings were up a remarkable 35% compared to last year.
35%. How?
A big driver is conversions. They represented nearly 30% of both room signings and openings in the first half of the year.
Conversion, so taking existing hotels and rebranding them.
Exactly. And if you think about the bigger picture, it lets them bring existing hotels into their system much faster and, crucially, more capital efficiently than building brand new ones.
Especially now with construction costs and financing.
Precisely. It's a smart strategic pivot, really leveraging existing infrastructure to expand quickly.
And it's not just conversions, right? They're expanding the portfolio itself, moving into new spaces.
Absolutely. Back in May, they announced the global launch of their latest collection brand, Series by Marriott.
Series by Marriott. Okay, what's the target there?
It targets the mid-scale to upscale segment. The idea is to affiliate established, quality regional hotels into their portfolio. Gives more choice for, maybe, more value-conscious travelers and new options for local owners.
Makes sense.
They've already announced a big founding deal to affiliate over 100 open and pipeline hotels across India with Series by Marriott.
India. Interesting.
Yeah, and they also recently closed on the acquisition of that innovative tech-forward lifestyle brand, Citizen M.
Ah, Citizen M. Right. So they're definitely building out mid-scale and upscale.
Yeah.
But what about the luxury end? Are they still pushing hard there?
Oh, definitely. At the upper end, Marriott continues to expand its global luxury portfolio. I mean, that segment is currently over 40% larger than their next closest competitor.
40% larger. That's huge.
It is nearly 168,000 rooms across 670 open luxury properties. And they plan to open another 27 luxury properties this year, with 270 more in the pipeline.
Wow.
Recent highlights include openings like the all-inclusive W Punta Cana, the JW Marriott Crete Resort and Spa, and the first voyage of Luminara, the third yacht in the Ritz-Carlton Yacht Collection.
A yacht collection. Right. Luxury is clearly still a major focus.
Absolutely, especially attracting that high-spending leisure traveler.
And all of this, I imagine, ties back to their loyalty program, Marriott Bonvoy. The numbers there are just staggering. What's the real power behind reaching almost 250 million members? Is it just repeat bookings?
Well, repeat bookings are key, but it's way beyond that now. That's where the network effect really kicks in. The program grew to nearly 248 million members by June.
Incredible.
And member penetration hit a record 69% of rooms globally, 74% in the US and Canada. But what's really fascinating is how they're leveraging that scale beyond loyalty points.
Okay. How so?
In June, they introduced the Marriott Media Network.
Media network.
Yeah, it basically allows advertisers to use Marriott's deep insights into traveler behavior and preferences.
Using the data.
Exactly. To reach these high-value audiences through touch points like the Bonvoy app, even in-room TVs, and they expect to share the revenue from this network with their hotel owners.
That's clever. It turns the loyalty program into a whole marketing platform.
Yeah.
New revenue streams.
Totally. And deeper engagement. You know, think about how these new brands, mid-scale to luxury, plus this expanding loyalty program and media network, might influence your future travel choices, even the ads you see on the go.
It really could change things. Okay, let's look forward now. What's the financial outlook? The big picture for the rest of 2025? It sounds like they're being a bit cautious.
They are. With the ongoing economic uncertainty, Marriott's estimating full-year global RevPAR growth will be at the lower end of their prior range, so an increase between 1.5% and 2.5% over last year.
Okay, tempering expectations slightly.
Yeah. For the third quarter specifically, they expect global RevPAR to be somewhere between flat and up 1%.
That to up 1% for Q3.
But they do anticipate Q4 RevPAR growth will accelerate from Q3, partly due to holiday shifts, timing of big events. You know, things like the positive impact from the Olympics and Euro Cup last year in Q3, the U.S. political conventions last Q3.
Right, these comps are tough.
Exactly. And then the negative impact of the U.S. election this Q4, plus F1 in Singapore shifting from Q3 last year to Q4 this year. It's a complex mix of factors they're juggling.
Definitely sounds complex. Now, you mentioned the group business has been a bit choppy near term, something about elevated attrition rates. What exactly does attrition mean here, and should we be worried long-term?
Good question. So attrition in group bookings basically means when pre-booked rooms or events get canceled or maybe significantly downsized closer to the actual date.
Ah, okay. People scaling back plans.
Right. So group revenues were pacing down 2% for Q3, but up 6% for Q4, reflecting those calendar impacts we just talked about. Full year 2025 group revenues were pacing up 3%, which is actually a bit below the pace from a quarter ago.
And that's because of fewer near-term bookings and this higher attrition.
Primarily, yes, based on what they saw in Q2. But, and this is the important part, what about future periods? Group bookings for 2026 have actually strengthened quite a bit.
Yeah.
They're pacing up 8% in the US and Canada, 7% globally, compared to where they were a quarter ago.
Okay, so the future pipeline looks stronger.
Exactly. And the quality of that future business looks excellent too. Food and beverage components are holding up well, especially in luxury hotels. So, yeah, some near term noise, but the long term outlook for group business seems quite strong.
That's reassuring. Okay, moving beyond the financials and even the brands, technology. How is Marriott using tech, especially AI? Seems critical for staying ahead.
It absolutely is. And they're right in the middle of a multi year transformation of their core systems loyalty, reservations, and the property management system, or PMS.
PMS, that's the hotel's operational backbone, right? Check-ins, billing.
Precisely. They expect to start rolling out the new cloud-based central reservations and PMS in US and Canada select service hotels later this year.
What's the goal there?
Well, the aim is to enhance staff training, create a smoother, more efficient experience for guests, and also give owners better tools to, merchandise and sell service.
Makes sense. And AI specifically.
They've actually stood up a Marriott AI incubator. They're working on proof of concepts like reimagining the concierge function.
AI concierge.
Kind of. Also things like helping out customer engagement center agents, using AI in the Marriott Homes and Villas platform, and launching an ambassador trip planning tool. The goal is really streamlining operations and creating more personalized guest experiences using data and AI.
Very interesting. Now, what about the wider environment? Economic, legislative. The call mentioned a big, beautiful bill. What was that about, and how does it affect Marriott?
Right, the big, beautiful bill. It likely refers to some significant piece of recent federal legislation. What Marriott management highlighted was the certainty it brings.
Certainty. Okay.
Yeah. While hotel owners are long-term investors, the stability from this bill being implemented is seen as a net positive. It's expected to help the transaction market open up a bit.
Making it easier to buy and sell hotels.
Exactly, which helps with capital recycling for things like hotel renovations. But Marriott's overall capital allocation philosophy stays the same. Keep their investment grade rating, invest in growth that adds shareholder value.
And return cash to shareholders.
Yeah.
And return excess capital through dividends and share buybacks. They still expect to return around $4 billion to shareholders for the full year 2025. So signaling confidence despite the uncertainties.
Oh, a billion. Okay. And one last piece of their residential business. It sounds like there's some volatility in the fees, but they seem really positive about it.
Yeah, the timing of those residential branding fees can definitely cause some lumpiness in the reports, but they stress they're a clear leader in branded residential globally. They're thrilled with continued openings and strong unit sales prices.
So it's strategic, even if the fees fluctuate.
Absolutely. These are high return on investment fees, often tied to a hotel right next door, and they add tremendous value, especially to the luxury brands. So despite free volatility, it's seen as a really strong strategic part of their overall portfolio.
Got it. And before we wrap up, there was some important personnel news announced on the call as well.
Yes, that's right. Marriott's chief financial officer and also executive vice president of development, Leanie Oberg, announced she'll be retiring in March 2026. Okay, a key figure stepping down.
Yes, described as a hard, bittersweet decision, but they emphasized utmost confidence in the succession plan. Jen Mason, who's currently Global Officer, Treasurer, and Risk Management, she'll become the new CFO.
Okay.
And Sean Hill, currently Head of Development for APAC, he'll step up to become Global Head of Development when Leanie retires. So a significant leadership transition, but with a clear plan already in place.
Good to know. Well, from digging into RevPair across continents to the rollout of new brands like Series by Marriott, AI integration, the group business outlook, leadership changes. We have covered a lot in this deep dive into Marriott's Q2 2025.
We certainly have, and it's clear, isn't it? Marriott isn't just reporting numbers, they're actively trying to shape the future of travel, adapting to different market conditions, embracing tech, strategically growing that global footprint.
So thinking about all this, what does it really mean for you, the listener? Maybe next time you book a hotel or even just plan a trip, you could think about this complex dance happening behind the scenes, the finances, the brand strategy, the tech, and maybe consider how might these ongoing shifts, from those targeted mid-scale hotels to maybe an AI concierge popping up someday, how might that fundamentally reshape what you expect from your travel experiences in the years ahead? Something to think about.